pleasant day to each and everyone. For today, we'll be discussing about the financial markets and all the underlying facts that isn't talked about more. But before we proceed to the definition itself, I'll be leaving some questions that should be answered after we elaborate the whole topic. So the hanging questions are, what is the importance of financial markets and what is the function of financial markets? And we cannot answer these questions if we don't have any knowledge about it. So I'll be proceeding to its definition first. What is financial markets? It is any marketplace where buyers and sellers participate in a trade. When we talk about markets, we think about a place to sell and buy goods and services. However, in reality, the term has a much wider scope. A market is basically a sum total of demand and supply of any particular commodity or service. So a financial market is a market or an arrangement or an institution that facilitates the exchange of financial instruments and securities. To understand the structure and the importance of financial markets, we must first understand their role in our economy. The next part would be the importance of financial markets. There are many reasons for the importance of it, but today we'll be only focusing on three major reasons. The first one is because it helps in economic growth of our country. How do we say so? Businesses need capital to grow and to expand their respective business. Thus, where the financial market plays a critical role in the build-up of capital and the production of goods and services, providing access to capital. In developing countries, which have limited financial market, the poor legal system, transparency may make it more costly to raise capital and may lower the return on savings or investments. It won't be wrong to say that investors and businesses access the financial markets to raise money and also to make more money. Moreover, they also help in lowering unemployment as these markets create massive job opportunities. To sum it up, good financial market helps in the creation of wealth and provides a link between savings and investment that meet the short-term and long-term financial needs of both the household and corporate sector through efficient mobilization and allocation of surplus.
Second importance of financial market is because it helps savers to become investors. Savers become investor and began to build businesses to grow their money. Savers are people who gives his or her money over to others to handle in hopes of making more, and begins to manipulate and handle that money themselves as a dynamic investor. Third importance of financial market is because it helps businesses to raise money to expand their business. Capital raising important, yet, ironically enough, you cannot get money until your business is successful enough. Using up your savings is one option, but savings will typically run out. Therefore, raising funds through other sources is important in order to finance all the business activities.
After knowing the importance of financial markets, let us now proceed to its function, and these are:
Determination of prices means to determine the cost of goods and services rendered in the free market. In a free market, the forces of demand and supply determine the prices. The government does not interfere in the determination of the prices. However, in some cases,
The government may intervene in determining the prices. For example, the government has fixed the minimum selling price for the wheat. Second, the mobilization of funds is the capital you need to mobilize or get started on a project after you won the contract. It is the fuel you need to launch your project. The mobilization fund will help you get the funding you need to succeed in your projects. Third, the insured liquidity refers to the ease with which an asset or security can be converted into ready cash without affecting its market price. Cash is the most liquid of assets, while tangible items are less liquid. The two main types of liquidity include market liquidity and accounting liquidity. Market liquidity refers to extent to which a market, such a country's stock market or a city's real estate market, allows assets to be bought and sold at stable, transparent prices. When the spread between the bid and ask prices grows, the markets becomes more illiquid, while in accounting liquidity is a measure of the ability of a debtor to pay their debts as when they fall due. It is usually expressed as a ratio or a percentage of current liabilities. Liquidity is a ability to pay short-term obligations. And the last function is it saves time and money because financial markets serve as a platform where buyers and sellers can easily find each other without making too much efforts or wasting time. Also, since these markets handle so many transactions, it helps them to achieve economies of scale. This results in lower transaction costs and fees for investors. Determine
Are the four types of financial markets. First is nature of asset. Under these are stock, bond, commodity, and derivative market. Second is nature of claim. Under these are equity market and debt market. Third is maturity of claim. Under these are money market and capital market. Lastly, delivery timing. Under these are cash market and futures market. Define the four types of nature of asset. First is the stock. A stock, also known as equity, is a security that represents the ownership of a fraction of a corporation. So basically, shares of a stock are bought and sold over stock exchange, which is also known as a stock market. Companies list their stocks for sale on an exchange. Second is the bond. The bond market is a financial market where participants can issue new debt, known as the primary market, or buy and sell debt securities, known as the secondary market. This is usually in the form of bonds, but it may include notes, bills, and so on. Stocks and bonds are also called securities, and people who buy them are called investors. But they have a difference is that stocks are shares in the ownership of a business, while bonds are a form of debt that the issuing entity promises to repay at some point in the future. The third of nature of assets is commodity. The word commodity is used in economics to refer to any good or product that has an economy value and due to this can be part of the market. This means any commodity can be traded, sold, or bought. Lastly, derivatives market. The derivative market is the financial market for derivatives, financial instruments like future contracts or options, which are derived from other forms of assets. We now proceed to the two types of nature of claim. First is equity market. Equity markets are the meeting point for buyers and sellers of stocks. The securities traded in the equity market can either be public stocks, which are those listed on the stock exchange, or privately traded stocks. The second one is debt market. It's the arena in which investment in loans are bought and sold. There is no single physical exchange for bonds. Transactions are mostly made between brokers or large institutions or by individual investors.
Money market refers to trading in very short-term debt investments. Money market is where companies and governments can meet their short-term borrowing needs. The money market is important for businesses because it allows companies with a temporary cash surplus to invest in a short-term securities. Conversely, companies with a temporary cash shortfall can sell securities or borrow funds on a short-term basis. In essence, the market acts as a repository for short-term funds. Capital market is a financial market in which long-term debt or equity-backed securities are bought and sold. Capital markets are one of the most fascinating areas of investment banking. Companies need these services when they are about to go public or want to issue debt sold to the public. When a company wants to raise equity, we talk about ECM, standing for Equity Capital Markets. And when it wants to raise debt, we talk about DCM, standing for Debt Capital Markets. Cash market is a marketplace in which commodities or securities purchased are paid for and received at the point of sale. In cash market, buyers can hold shares for long period profit and risk limited. Cash market is almost the same with the money market, so this is the difference between money market and cash market. The money market is the trade in short-term debt. It is constant flow of cash between governments, corporations, banks, and financial institutions borrowing and lending for a term as short as overnight and no longer than a year. The capital market encompasses the trade in both stocks and bonds. Futures market. A futures market or futures exchange is a central financial exchange where people can trade standardized futures contracts defined by the exchange. In future markets, the economy are having a future contract, which is they are having an agreement to buy or sell some commodity on a given date for a given price. Futures market allow market participants to hedge against future price changes by buying and selling ownership of the asset in the future, as opposed the spot market in which trades are executed immediately.
Structure. First, exchange-traded market are the one in which all transactions are routed through a central source. In other words, one party is responsible for being the intermediary that connects buyers and sellers. Additionally, it also refers to a centralized and regulated financial market where securities, commodities, derivatives of listed companies are bought and sold between stock brokers and traders. Second one is over-the-counter. Over-the-counter or off-exchange trading is done directly between the two parties. Without the supervision of an exchange, it is contrasted with exchange trading, which occurs via exchanges.
To answer the questions we left earlier, the importance of financial market is it helps in the efficient direct flow of savings and investments in the economy, which facilitates the accumulation of capital and contribution in the production of goods and services. While the function of financial markets is the interaction of buyers and sellers that determine the price of traded assets. And that's how our discussion ends. Thank you for sparing us your time to listen. We hope that you learned something from the topic that we discussed and have a good day ahead, everyone.